You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu.
Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you had a great weekend. Today, we're going to talk about A&W Revenue Royalties Income Fund. Yeah, that's a long name. Merging to make things simpler with A&W Food Services. So big news in the restaurant industry. I'm talking about this one because if you are a shareholder of A&W Revenue Royalty, that ticker is AW.UN. That was your way to participate in A&W franchise. Of course, the second largest fast food franchise in Canada. Famous for its burgers and, of course, its root beer. And now you have to make a decision. You have to make a decision before October 7th, 2024 at 10 a.m. Vancouver time. So October 7th, which is in a week from now. So that's why I'm doing this podcast. So the choice that you have is either you are going to sell your shares of A&W Fund and receive $37 in cash, which is pretty cool because it's a great bump, as the stock was trading around like $29 before the announcement. Right now it's at $35, so there's like almost like a $2 bonus that you can get. Or you are willing to exchange it to have shares instead of units. So in terms of taxation, that will have an impact because now it's not going to be a distribution, but rather a dividend. So you will be owner of the A&W Food Service as well. So they merged the two companies together so that you can be exposed to more growth potential. So when they open like new restaurants and so on, so instead of like just getting a royalty from the business, you participate on all the risks, of course, and all the growth that is offered behind A&W franchises. So if you decide that you want to continue this adventure with A&W, the choice you have is either you just exchange your share one for one, or like just to make it a little bit more complicated, you can also decide to get 67.5% in shares and the balance 32.5% in cash. And I got a lot of questions, of course. So now, do you want to sell at $37? Do you want to have the shares of the new company, or do you want to have like partially, like 2/3 of shares, 1/3 of cash, roughly, in terms of percentage? And this is the choice that you have to make before you move forward. So let's go back to the company for a second. I think it's really important. A&W was growing relatively fast before COVID. 2023 was a little bit rougher in terms of annual sales growth at 2.7. 24 is not that great so far. And for 2025, they expect a same-store sales growth of like 3 to 4.5%, which is pretty good. And 3 years horizon is between 3 to 5% annualized growth rate. So again, that's decent for same-store sales growth. They, of course, intend to increase the number of restaurants, so they expect to go from 1,054 in 23 to something between 1,080 to 1,095 by 25, and up to 1,160 in 3 years. So growing a little bit every year in terms of restaurants, so that should generate a total annual system sales growth. So now we're talking about same store sales growth plus the new restaurant between 5 to 7% on an annualized basis for 25, 26, and 27. So when you're thinking about, is this company still growing? Yes. Do you want to participate in that industry? And that is probably like the biggest question you have to ask yourself. I used to be a big fan of A&W. Never had it in my portfolio. It's a small cap. You have to consider this as well. I mean, we're talking about like $500 million market capitalization. Once the merger happens, it's going to be a little bit better, but it's still not going to be a large cap. I mean, you cannot really compare it to McDonald's, to be honest, right? But it was doing well. It it got outside of COVID and worked very hard to put back the distribution in place to continue to grow. They are quite innovative with their menu, trying to bring new burgers and other products to attract more customers, which is pretty much like the name of the game here when you're looking at the fast food service. There is a limited potential in terms of growing in terms of new restaurant. You can see that. It's going to be like growing by like 2 to 3% per year, and at one point we're gonna like see a maximum of restaurants of that type, because you compete against Burger King, you compete against McDonald's, and you compete against other fast foods. Because I mean, if I'm hungry for lunch and I have the choice between A&W and McDonald's, but I can also consider Subway, for example, or going to eat at Tim Hortons and so on. So there's a lot of offer in this field. It is cyclical. Of course, they will try to attract like everybody with like their value menus and stuff, like, and rebates, but it's going to be not that easy to grow down the road. So at this point, you're more facing a dilemma between, do I want to keep this adventure? And that could be interesting, because now that everything in the same basket, you're going to get the full picture. The numbers are going to be easier to analyze, and hopefully we're going to go back on track for a dividend growth. So the distribution becomes a dividend, but the amount doesn't change, just like a little bit better tax-wise if you are in a non-registered account, because it's going to count as a eligible dividend. But overall, that's pretty much it. So do you want to keep a fast food restaurant chain in your portfolio? If yes, well, you can continue this way. If you don't, well, it's a good exit at $37, which is almost the price that the stock was trading before the pandemic. So it was like a little bit over, around like $38. So if you don't want to have the dividend anymore, that's great. One thing I didn't like before the merger is the company stopped increasing its dividend. So that's why we liked it at DSR for a while. But then when we saw that the distribution back then was not increasing anymore, of course, it lost some ratings. It's just normal. The company is slowing down. It's struggling. Now they're trying to pull out this big change, which I think is going to be beneficial, just for the fact that now you can see everything at the same place. But it will be depending on your investment thesis at this point. Because from an investment point of view, you get the same yield, you get the same dividend, you still invest in the same business. So now it's just, and then you get some kind of like a bump in the valuation. So you're now at $37, which is great. But I mean, not the end of the world either. It's not going to completely change everything. So the question you have to ask yourself right now is, what is the reason why you want to have A&W in your portfolio? Maybe it's for diversification. Maybe you like the fact that it's a challenger in that industry. Small cap could bring a lot of growth to your portfolio as well. So there are a lot of like positive things that could happen for A&W. On the other side, I mean, small caps are either great or either terrible, I would say. So expect a lot of volatility on both ways. Is the dividend is going to go back on track and grow? That's going to have a huge impact on our analysis at DSR, to be honest. We're going to wait for a few quarters to see what the numbers look like, if the projections of the revenue growth for same stores and also for the new stores is also happening. Because if we have revenue growth there, and then we will be able to see how earnings per share will fluctuate according to the revenue. If they're back in line and they're growing both, and the company maintains good margin, well then it could become an interesting play in this sector. Just don't get to fall in love for the yield alone. It's never a good thing. You have to put some meat on your burger, right? You cannot just like fall in love for the bread or for the root beer. You need to have the whole package here. So make sure that you do a good analysis. But in terms of the deal, it's really about Do you want to continue this adventure as a corporation and get dividends instead of distribution, or you're just looking for a way out and here's your chance, $37. Not a bad price considering that you had an asset at like $28, $29 not so long ago. So that could be a good way for you to get out. But I would not necessarily go for like the halfway, like 1/3, 2/3. I mean, yes, you get a little bit of cash, but is it going to make a difference in your portfolio? So I rather invest with conviction as always. So I would just ask myself, do I want to keep A&W in my portfolio? All right, Moose, I hope that I've helped you made a decision, trying to highlight the key points here for A&W. Actually, if you go on their website, they have an amazing, like they have like two presentation, one from management presentation, the other one from the transaction itself. It explains everything. It's really, really well done. So I really suggest that you go on A&W website, look at the transaction and the management presentation, and you'll have a better idea of like what to do with your shares. All right, Moose, that's enough for today. I hope that you will enjoy your Monday, and we're going to talk again tomorrow. Until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.